Welcome to Market Brain, where we dissect the fascinating, often absurd, world of financial engineering. Today, we're peering into the realm of ultra-fast trading bots, specifically those designed for scalping commodities like gold. This isn't about get-rich-quick schemes, it's about the relentless pursuit of efficiency and the intricate mathematics behind trying to profit from price movements that last mere milliseconds. Prepare to have your understanding of market dynamics stretched to its limits. So, what exactly is scalping? Imagine you're a market vendor, but instead of selling whole apples, you're trading tiny slivers of an apple. You buy a sliver for $1, immediately sell it for $1.01, and repeat this hundreds, even thousands, of times a day. Each profit is minuscule, but the sheer volume adds up. This, in essence, is scalping, an ultra-short-term trading strategy designed to capture small price movements. Mathematically, a scalper seeks to profit from the difference delta S equals S at time t plus delta t minus S at time t, where delta t approaches zero, aiming for a positive delta S after accounting for costs. It's about exploiting fleeting imbalances in supply and demand. But how do you even begin to model price movements over such incredibly short durations? At this microscopic level, prices aren't just smoothly drifting, they're bouncing around like a hyperactive particle. We often approximate this with stochastic models where price changes are driven by a combination of a tiny, predictable drift and a much larger, unpredictable random component, often modeled as a Wiener process. For scalping, the random component is often the primary source of both opportunity and risk, as it generates the rapid fluctuations. Now, trying to manually execute thousands of these microtrades is like trying to catch individual raindrops with a thimble. It's humanly impossible to react fast enough, consistently, and without emotional bias. This is where automation steps in. An algorithmic bot can monitor markets 24/7, execute trades in milliseconds, and follow predefined rules without hesitation, turning a theoretically sound strategy into a practical one. It removes the squishy human element from the equation. However, those tiny profits are constantly battling against an invisible enemy: transaction costs. Every buy and sell incurs fees, spreads, and slippage. If your average profit per trade, denoted by pi, is less than your average cost per trade, C, then you're simply losing money, no matter how many trades you make. The net profit per trade is pi net equals pi minus C. For scalping, C can easily eat up pi if not managed meticulously, making the strategy incredibly sensitive to execution quality. So why focus on ZOST, or gold, for such a strategy? Gold is known for its high liquidity, meaning it's easy to buy and sell without impacting its price too much, and crucially, its volatility. When global markets experience uncertainty, or when specific economic data is released, gold prices can exhibit rapid, short-term fluctuations. These periods of heightened activity create the very wiggles in price that scalpers aim to exploit, offering more frequent, albeit tiny, profit opportunities, but also increased risk. This is where the research aspect of projects like the EA_Scalper_ZOST comes in. Machine learning isn't about predicting the future with certainty, but about identifying subtle patterns in noisy data. An ML model might learn to predict the probability of a tiny upward or downward price movement within the next few milliseconds, or optimize entry and exit points to minimize slippage, giving the bot a fractional edge. It's about finding statistical advantages in the chaos. Ultimately, building a successful scalping bot isn't about finding a magic signal, it's an immense engineering challenge. It's about ultra-low latency infrastructure, robust risk management, meticulous backtesting, and continuous adaptation to changing market microstructure. The goal isn't to claim guaranteed profits, but to build a system that can consistently execute a mathematically sound strategy under the most demanding conditions. It's a testament to the relentless pursuit of efficiency in financial markets, a fascinating blend of math, code, and sheer computational power.